China's 1 trillion yuan plan. Hi, everyone, and welcome to Ainsley Insights, brought to you by Ainsley Bullion, Ainsley Crypto, and the Gold and Silver Standard as the Ainsley Group celebrates 50 years. Today, we welcome back Sam, who's been looking into actions being taken by China that could see a whole lot more liquidity flooding into their local markets and subsequently flowing through to have a global impact, I imagine. How are you going today, Sam?
Good, Chris. Good to be back.
Good to see you. Now, very interesting. These are big numbers you're talking about. 1 trillion yuan. I mean, a trillion's a big number in any currency these days. So, um, give us a bit of background. What's going on there? What are they attempting to do? And potentially, also, is it going to work? What are they actually getting at here?
Well, what China's been doing, if you look at the past couple of weeks, is they've been cutting mortgage rates, key policy interest rates, and now they're talking about or speculating on a big $1 trillion Chinese yuan plan to stimulate, essentially try to get their stock market pumping. Pretty artificially, I would say, just with easy money. And they've been trying to do this for a long time, but it seems like in the past couple of weeks, they've really gone on an absolute blitz trying to stimulate their economy.
Is it comparable if we think about things like the global financial crisis? How big is this number? Is it something comparable to what we saw then? How do you view it?
It would be the biggest injection of capital since 2008.
Right.
So this is absolutely massive. What China's doing is looking like another global financial crisis, except it's kind of happening in another part of the world, and they're trying to get on top of it early, it looks like.
And if you think about, obviously, this seems probably complementary to what's going on in the US, I suppose, with they're talking about rapid cuts potentially coming in rates there. Is it part of the same thing? Is this going to have a bigger impact on the world? How do you view what's going on here in the China context impacting the rest of the world?
It's interesting. A lot of analysts are saying that the reason you're seeing certain things, certain hedges, like we've seen gold take off so aggressively, we've seen, the stock market doing really well in the United States. We've seen other hedges like Bitcoin hold on very well and kind of break out of what looked like not too strong patterns. A lot of people are saying that's the liquidity coming from China, essentially kind of spreading around the world, and it makes a lot of sense. I mean, look at how everyone watches the U.S. like an absolute hawk about every little interest rate cut. Well, China's a major player. They're the second world's largest economy. So we really have to watch what China's doing with its liquidity. And as you point out with your liquidity reports, it's not as easy as just looking at, America controls world liquidity. China is a huge part of the equation.
And absolutely, I completely agree with that. I mean, that's what we tend to look at, or I tend to look at, particularly that liquidity angle. And I know that drives a lot. And I know China has had a big play in, or a big part in that this year, and looks like about to have a much bigger part. But what's your
Yeah.
take on the sustainability of that? Because ultimately, we know, like if you're the US, for example, you can go and print to your heart's content because you have the global reserve
Yeah.
currency. There was concern earlier in the year about the impact on the yuan if they effectively did this. Has something changed there, or how do you think about that in terms of sustainability?
Well, I think what they're doing is it's really a funny money policy because I mean, look at some of the things they're doing. Not just cutting mortgage rates and interest rates slightly, they are getting really desperate. I mean, they've put 500 billion yuan forward for loans. These are to lenders and brokers to go out and just buy up stocks. And to top it off, one of the biggest things is they've given 300 billion yuan to fund share buybacks. So again, I always rail on about how Warren Buffett says there's no reason to do share buybacks unless you're desperate or your company doesn't produce anything. Well, imagine the central bank of the country. So China's central bank's giving listed companies money to just go ahead and buy their own shares. I mean, if you're one of these companies, it's a dream come true. But if you are, say, just a citizen there or just someone looking at the sustainability of this, it's ridiculous. They're paying companies to look good. So at the country's expense.
And ultimately, I mean, you've talked about this a lot. The cost of living crisis is something that we've been very focused on here
Mhm.
in Insights and just generally when we're looking at the news and all of that together. Surely this is going to have a lot of people worried, at least, about inflation coming back in a big way on the back of all this new liquidity coming in. Do you think that's the case here in China, or is there something else at play? What's your view on that?
I think it is the case. I think inflation is just going to take off all over again. And if we, look at the traditional definition of inflation, it's the quantity of money. So there you go. It is back. So the quantity of money is going back up. One thing interesting, though, that's been posited is that say you look at the U.S. So say you're in the U.S. now, or say you're in whatever country now, and you're thinking about buying a house. So you know a thing or two about interest rate cuts, and everyone's talking about the cutting cycle getting lower. So are you going to buy a house now, or are you just going to wait a year and get lower rates and buy then? That's another thing that isn't being discussed too much. Is okay? Is people refinancing? Is that going to cause a big problem for inflation? Wait until the cuts get really low and the rates are really good, and people start massively buying. Taking out mortgages. That's going to be the real damage where the cost of living gets out of control. At least I think.
And that makes sense. And we've been through that period with all that stimulus that we saw out of the COVID spending. And if you're saying this is the biggest stimulus from the China perspective since the 2008 financial crisis, it's a lot there. It really could be, at least from China's perspective, another version, like another go at what we just went through. And we know what happened to house prices in that scenario.
Yeah, I mean, look at what happened in 2008 to gold and silver and other investments, just people trying to get out of cash. And then you look at COVID again, the sharpest sell-off since the Great Depression, and then just a massive bull market for, gold and silver and risk assets as well. So you look at what they're doing now, they're trying to essentially melt up or not have a crash and print so aggressively things just float even higher. That could spell disaster for inflation.
And probably the last question, just to wrap this up, you've obviously talked about it before. This has had a big impact on the price of gold, probably front running some of this. We're at that all-time high sort of level. There's some people who are arguing that we're probably a little bit extended here and we see a bit of a pullback. But is it possible that it can just keep going in an environment where you've got central banks, as you said, buying back stocks and doing like pretty, certainly not standard policy, like what you would expect from a central bank?
Well, look, I remember, advising clients who are calling in and saying, I'm going to keep my leveraged short positions open on gold. I think gold's going to go down, and just saying, look, do you see what the central banks are doing? Do you see the policies that are happening? You can't just look at a chart and say what goes up must come down. And believe it or not, this is what people with millions of dollars will look at charts and say, as if some sort of gravity is going to come in and push it back down. It doesn't work like that. If the supply of money is increasing, it does not somehow become more valuable. It becomes less valuable. Unless we have, I don't know, AI coming out and whatever, 10 times or 100xing the economic output or something. It just doesn't seem feasible that cutting interest rates and producing trillions of dollars, and in this case, China producing looks like maybe a trillion Chinese yuan, pumping it into the market, that's going to, that's not going to result in huge inflation and the price of gold going up. So look, I guess my general statement on that would just be look at what central banks and what's happening to the money supply, and don't look at the chart and think, how do you feel, or is gravity going to kick in? That's all I would say about that.
Yeah, and that makes so much sense to me, because you're not necessarily saying this time is different, because people will argue, well, mean reversion, everything comes back eventually. Well, it might, but we don't know what it's going to revert to. It might end up much higher and revert back to a higher base than where it is here. So, trying to time that can be very difficult. And at the moment, more important thing. It's always don't fight the Fed, but at the moment, it might be don't fight the People's Bank of China, I suspect.
That's a good way of putting it. Yep.
Yep. Well, thank you so much for that, Sam, alerting us to that. And we'll keep paying attention because that is certainly going to be a story that's going to continue to unfold. That's a lot of money to flow through. So we'll keep watching it. But thank you for your work on that.
Thanks, Chris.
Thanks, everyone, for watching. We'll chat again soon.